This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on trends. I'm going to begin by talking about the different types of trends, and then I'm going to be talking about the bull and bear versions of the trends. And finally, I'm going to be talking about traps and breakouts. Traps are failed breakouts. Trends are important because they offer a lot of profit opportunity, but traders need to understand how they operate. And for me, a good starting point is classifying them into different types of trends based upon their behavior. Every trend bar is a breakout. Every series of trend bars is a breakout. So bull breakouts here, bear breakout there, bear breakout here. And every trend is also contained within a channel, although the channel sometimes is not particularly obvious. Here we have a rising wedge channel, and we have a falling channel that is also a wedge channel. A breakout, it can be a single bar, it can be a series of bars. Trends are either in a breakout phase or a channel phase, and a breakout is the strongest type of a trend. I sometimes call it a spike, so I would call this a spike and channel bull trend. And every trend bar is also a climax. Climax does not mean the trend reverses or the trend even pauses. Sometimes a climax just gets more climactic and the market just keeps going up. Every trend is either a breakout or a channel. A channel is a weaker type of trend in which there is two-sided trading. So you get bulls in control for a part of it, bears in control for another part of it. And the way you draw channels, it's rarely perfect. The lines are rarely perfectly corresponding to the points in the channel. Every trend begins with a breakout, at least a small breakout. Here we have a gap open. So here's the end of one session, the start of another session, and we have a big gap down. And the gap immediately closed. The market had a series of bull trend bars closing on their highs. Not much overlap between the bars. As soon as this bar closed, a lot of traders just hit the button to buy the market. And you can see the open of the next bar did not fall below the close of this bar. And the same thing here. There's a lot of urgency on the part of the bulls in this particular breakout. As soon as this bar closed, traders did not place a limit order to buy the close. As soon as the bar closed, they hit buy the market. And so the low and open of this bar never fell below that close. So this is a strong reversal up. And every trend bar or series of trend bars is a breakout. Does not matter that you do not see the breakout or understand what the breakout is, but that's how you have to think of it. You can think of this as a very steep bear trend, and we broke above it. So I could draw a trend line from this high to this high, and we're breaking above it. A series of bull trend bars, good-sized bodies closing in their upper halves. Here they're closing near their highs, and it could be one bar, it could be many bars. We gap down, which is a bear breakout, and then we reverse up, a bull breakout. This is a very strong breakout, very strong bull bars. No tails on the bottom, closes on the high, very small tails on top. Sometimes a breakout is made up of less impressive trend bars. For example, we have a breakout here and another breakout here, and this one contained a doji, small bar, closing around its middle, and this one had a doji here and again here. It's not as strong as the other one, but it's still a breakout, and it's still a strong bull trend. You want to see most of the bull bars closing at least above their midpoints, preferably at their highs, and it's stronger yet if there's very little pullback below the close of the prior bar, very little overlap. Most bear trends begin with some kind of a breakout. Here we got a breakout, we have another breakout here, another breakout here. And look at this bear trend. It's mostly bear bars closing below their midpoints or near their lows, and we have several series of consecutive bear trend bars. So that's relentless selling. And look at this bar. As soon as it closed, traders hit the button, sell the market. Look at the open and high of this bar, did not get above that close. So this urgency all the way down, very little overlap, very little overlap. And that increases the chances that the market will go lower. Sometimes a small breakout can lead to a big trend. This is the euro versus the dollar, a 10-minute chart. Now look at this. There's time on the bottom. This is a 10-minute chart, and there's price on the vertical axis. It's a two-dimensional chart, price and time. It's easy to think that breakouts have to begin with price only, a big move in price. Well, they don't. Breakouts can take place over time, made up of lots of small bars, as is the case here. After 20 or 30 bars, you have to conclude that even though we're not getting huge bars, it's still a bear trend. Look how tight the channel is. Look how small the pullbacks are. They do not go up very far. They only last 1, 2, or 3 bars. And on a higher time frame chart, this is a strong breakout. We have a little breakout here, a gap between this high follow-through bar and this low, the bar before this small breakout bar. You can get a small breakout and it can lead to a relentless trend that can go on a long time. And channel, here the channel is maybe 30 bars without a pullback. Whenever you see an endless pullback like this, we have a bull trend, and initially the bull saw it as a pullback, yet it's a never-ending pullback. It's an endless pullback. And once you get 20 or 30 bars down, you have to be thinking at some point the bulls give up, and you can get a big bear breakout that becomes a measuring gap and leads to a measured move down. Here, the bulls finally gave up. So it's no longer a bear channel, bull flag, it's now a bear trend. We have a big breakout bar and a big follow-through bar. Typically, that's what happens when you have an endless pullback and finally the bulls give up. Usually you get a pair of big bear bars closing near their lows, and it usually becomes a measuring gap, and the market typically falls for a measured move down. Here we have what the bulls think is a bull flag, but it just keeps growing, growing, and growing, and then we have a breakout below the bottom of what was a bull flag, and the market fell for about a measured move down. So it's no longer a bull flag once these 2 bars come, and now everyone concludes that it's a bear trend, and it probably will fall further, and this probably will end up as a measuring gap. There are many different types of trends, and they behave differently. So it's good to distinguish the differences among the different trends because you trade them slightly differently. In general, especially if you're starting out, it's better to only swing trade. Once you think the market is going up, here we got a bull breakout and small double bottom, this bar, that bar, a bull close. So you buy there and you stay long until there's a good reason to get out. And this is not a good reason. Neither is this triangle. 3 pushes up, 1, 2, 3. And these reversals are not strong enough for the bears to take control. So the bulls hold long. You need a good reason to exit. And these are not good reasons to exit. Trends behave the same on all time frames. And it doesn't matter what time frame you're using. On intraday charts, I use some names that are different, but there are corresponding types on the daily chart. So sometimes if we gap down here and just started trending up from the open, I would call it a trend from the open bull trend. On a daily chart, instead, I would probably just call it a tight bull channel. And if this were a 5-minute chart and this was the open of the day, I would just call it a trend from the open bull trend, or possibly a small pullback bull trend. Now look at this chart. We have a spike, pullback, and you can call the whole thing a channel, or you can call it another spike and channel, or another spike and channel. And just about every trend at some point has a spike and channel pattern. It has a breakout and then a channel. If this is a gap down open, or if this is the open of the day, and we did this, you could call it a trend from the open bull trend. It's clearly a spike and channel bull trend. And again, almost all trends have some component of a spike and channel to them. But if this is a trend from the open bull trend, they happen about once a week on an intraday chart. It could also be a trending trading range day where the market breaks out and then forms a big trading range, although in this case it has not yet formed a trading range. You can argue there's a trading range here, trading range here, trading range there, and it's a trending trading range day. Typically a trending trading range day just has a couple trading ranges, and if you start to get 4 trading ranges like this, I don't use that term trending trading range day. Instead I would call it a spike and channel bull trend. I would call it a trend from the open bull trend. If this is the open, it clearly trended from the open. And I would also call it a spike and channel bull trend, where this is a spike and then channel. We had another spike within the channel, forming another channel. Is it a broad bull channel? Well, it's fairly broad, so you can also call it a broad bull channel. And there are other types of broad bull channels, like wedges and stairs. If it's a small pullback bull trend, this is really not a good example because the pullbacks are too deep. Small pullback bull trends are the strongest types of bull trends, and they occur a couple times a month. This is, I think, more of a spike and channel bull trend. Spike here, or you could say the whole thing is a spike, and then starting to channel up. And I would not call it a trending trading range day. It's also a broad channel. The pullbacks are fairly deep, and it spends a lot of time going sideways. That's characteristic of a broad channel. On the downside, we have a bear breakout and then a channel. A bear breakout, a pullback here, a bigger pullback here, and then a channel. Again, most bear trends have a spike and channel bear trend within them. If this is the open of the day, then it's also a trend from the open bear trend. And here we had a trend and a trading range, and the bear trend resumed. It's also a trend resumption bear trend. All bear trends have a spike in channel component. Is this trending trading range day? Not really. We only have one trading range. We have a breakout, did not form a second trading range. Is it a broad bear channel? Well, not really. You can argue that this is a broad bear channel, but to me, this is more of a strong breakout, trading range, and then another strong breakout. Is it a small pullback bull trend? No, this pullback is too deep for this to be a small pullback bull trend. I would call this a spike in channel bear trend. If you want, you can call it a trend resumption bear trend. Let me talk a little bit more about bull and bear trends. There are many ways to classify trends, but usually one is the dominant type on a chart. If this is the open of the day, you can call it a spike in channel bull trend. You can call it a trend from the open bull trend. You can call it a tight bull channel. It is pretty tight. You can also call it a trending trading range day. We have a trading range, a brief breakout, and another trading range. The pullback overlapped the lower range, and then we resumed up again. Again, all trends begin with some kind of a breakout, and then it has a pullback here, or you can call this whole thing a pullback, and then you get a channel. So here we have a breakout, a spike, and then we have a channel. And again, sometimes it's not obvious what the channel is. And did the channel begin here? Did it begin here? Did it begin there? It doesn't matter. Some computers will use any of those three. Bear trends also usually can be classified more than one way. This is a good example of a small pullback bear trend. If this is the open of the day, it's a trend from the open bear trend. A very tight channel here, so it's a breakout on a higher time frame. It's a spike in channel bear trend. Look at the pullbacks. They only last a bar or two, and the market just continues down in a very tight channel. So it's a tight bear channel, and it's also I think, a small pullback bear trend. I would call this a small pullback bear trend. All the pullbacks are really small. It's the strongest type of bear trend on a higher time frame chart. This entire sell-off is a breakout, a bear breakout. Again, a bear micro channel lasting about 10 bars or so. It's a breakout on a higher time frame chart. It's a spike, and then we have a pullback, and then a channel. So it's a type of spike and channel bear trend. And all trends have some component of spike and channel bear trend to them. But this is mostly a small pullback bear trend, and it's better to only short. I want to talk a little bit about getting trapped into bad trades, getting trapped out of good trades. Talk a little bit about breakouts as well. At some point, you look at this and you say, it's a bull trend, right? So if it's a bull trend, don't sell. Don't be selling highs. Don't be selling reversals down, especially a trend like this where the pullbacks are so small. So it's really easy to get trapped into shorts. You sell and immediately it reverses up, trapping you into a loss. It's also easy to get trapped out of longs. You say, well, it's dojis, bear bars, it doesn't look all that strong. I'll wait for a deeper pullback to buy. And the market just keeps going up. Beginners, they love to sell bull trends. Oh, maybe we're reversing. Buy climax. We have a double top here. We have a wedge here. We have another wedge here. They're always looking for reasons to sell. And there's only one reason why they are selling. It's because they are afraid of risk. They equate losing their account with death, the death of their dream as a trader. And so all they focus on is risk. They do not focus on probability. And that's a terrible mistake because some days are small pullback bull trends or strong bull trends. And yes, the risk shorting is low, it's small. So you sell below this bar and you're not risking much, but you keep losing. Yes, the risk is low, but the probability is extremely low. It's impossible to make money or consistent money selling in strong bull trends. Okay, so beginners keep selling, saying, I'm not risking much. Selling, not risking much. But all of those small losses add up. And anytime you're taking a trade with low risk, you also are taking a trade with low probability. And it's very difficult to make money if the probability is very low, as it is selling in a strong bull trend. You just keep getting stopped out. Beginners only think about risk, and therefore they end up only selling when the market's in a bull trend because the risk is small, and they only end up buying in a bear trend because the risk is small, and they totally ignore probability, and they end up losing money because the probability is too low to be able to trade profitably. Once you think the trend is up, don't get trapped into repeated shorts. Don't be selling. You just keep looking for buy opportunities. And strong bull trends rarely have good looking buy opportunities. This is not a good looking high one, neither is this. That's not a good looking high two. We got a bear reversal and a doji, not good looking. But the signal bars, even though they do not look good typically, they're reliable. The probability is high. So experts buy and they just decide where the correct stop is. Bull breakout, not much of a strong bull breakout here, so the stop is still down here. So you got to buy. You got to allow for the possibility of a deep pullback, but you have to buy, and you just use the correct stop and trade small. Every time you see the market trying to resume back up, you buy, and the stop is way down here, so you trade small. And then after you get a strong bull breakout like this, then this becomes a major high or low. You can raise your stop from here up to there. So when you're buying over here, your stop is now down here. And beginners, they don't buy, because even buying here, for them, the stop is too far. They don't want to risk that much. So they keep shorting where the stop is closer, and they keep losing because the probability is so low. Look at this. Strong bear trend. You can only sell. But it's really easy as a beginner to get trapped into longs. You keep buying, betting that the reversals will give you at least a scalp. And you're buying because the risk is small. Maybe you buy above this bar, this bull inside bar, put a stop just below, and you say, okay, I got stopped out and did not lose much money. But if you do it again here and here and here and here, you end up losing a lot of money. A lot of small losses can add up to a lot of money. And then beginners, they also get trapped out of taking shorts because they keep waiting for bigger pullbacks to sell and they never get short. A strong trend like this traps beginners into longs. They keep buying because they're concerned that they don't want to take trades where the stop is far away, and they never short because they know the stop is way up here and they don't want to risk that much. Only focusing on risk and ignoring probability, you will lose money. The trader's equation has 3 variables: risk, reward, and probability. Beginners typically only think about risk and they're buying constantly. Even in a very strong bear trend, they just keep buying reversals up, and they get quickly trapped into a losing trade. The market resumes back down, and eventually they wipe their account out. In a strong bear trend, the signal bars rarely look good. You want to sell below that bull bar? Well, it's not that good looking a sell, but it's a strong bear trend. Below this bull bar, small doji, the sell setups never look all that good. However, the chance of a reversal up is small, and if you do get a reversal up, it'll be minor, and you'll test back down. Experienced traders use the appropriate stop, sell at any time, any reason, and they take these sell signals, even with the bad sell signal bars, knowing that the odds are, if the market goes up, it will not go up that bar. So when you're trading in a strong bear trend, and you're looking to short, you can sell at the market, you can sell with stops, but if you're taking stop entry shorts, which is fine, and most beginners should do that, the sell setups never look good enough, yet the market continues down. The key is using the correct stop, which means risking more than you might like to risk. However, that's the only way to trade this. So use the correct stop and trade very small. The beginners, they don't sell because they don't want to use a stop that far away. The risk is too big. And because they are so afraid of a stop this far away, they get trapped out of very profitable shorts and they miss the entire trend. When I see a bear channel, I immediately think bear channel, bull flag. 75% chance there's going to be a bull breakout. 25% chance there'll be a bear breakout and the trend will accelerate downward. We have a spike down, a micro channel, a breakout higher time frame, and then a channel. So channel usually evolves into a trading range. 75% chance you're going to get a break above this trend line. I think of every bear channel as a bull flag, even if it's a bear channel and a bear trend, because 75% of the time you're going to get a bull breakout. Usually not as dramatically bullish as this, but still 75% of the time a bear channel is a bull flag and you get a bull breakout. Typically when you have a spike and channel bear trend like this, so spike and channel, you get the bull breakout. It tests around the beginning of the channel. Here we went quite a bit above, and then you end up evolving into a trading range. So down and up and up, and then down and sideways. And then after you have the trading range, the market again decides on the direction of the breakout, up or down, and it can be in either direction. Anytime I see a bull channel, I think bear flag. 75% chance you get a bear breakout. Does it become a bear trend? Not necessarily. It can break out simply by going sideways. But bull channel, bear flag. 75% chance of a bear breakout. So I always think of every bull channel as a bear flag, expecting a bear breakout and a conversion into a trading range, sometimes into a bear trend, as it was here. And usually the market tries to test the beginning of the channel, which is down here, and you can see it fell below the bottom of the channel before the buyers came back. And so typically you get a bull channel, and then a bear breakout, and a conversion into a trading range. And at that point, the market decides whether to break out again to the upside or to the downside. In this video, I talked about the types of trends and why it's important to classify trends into different types because you trade them differently. I then talked about bull and bear trends. Finally, I talked about traps and breakouts, how beginners tend to get trapped out of good trades and trapped into bad trades. And I also talked about breakouts of channels. Every bull channel is a bear flag, 75% chance there'll be a bear breakout. Every bear channel is a bull flag, 75% chance there'll be a bull breakout. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on trends. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on trends. I'm going to be describing 3 types of trends in this video. The first is a trend that begins on the open. The next I'll talk about trending trading ranges. And finally, I'll talk about trends that are broad channels. When I talk about a trend from the open, I don't necessarily mean a trend from the first bar of the day, although it often begins with the first bar. In general, the first bar of the day has a 20% chance of being either the high or low of the day. When you have a trend from the open like this, the more bars that get added to it, the more likely this ends up as the low of the day. Here, we had a gap up. I'm not showing much of yesterday, only 2 bars. We have a gap up, and then the first 2 bars are bull bars. That alone is enough for me to think of the day as always in long. That is enough to make me think that the market's in a bull trend. Even though both bars have tails, one of them has a body that's at least half as big as the entire bar, plus it's a pretty good sized body. The trend continued, traders were buying all the way up, and we had an 11 bar bull microchannel. No bear bars, no pullbacks for the first 11 bars. We also started to get consecutive bull bars closing near their highs. And when you get that on the open like this, the odds are 60% or greater, you're going to get some kind of a measured move up. For example, based upon maybe the open of the first bar to the close of the second bar of the breakout, and a measured move up takes us to around there. When you see that on the open, a gap up and then 1 bar, 2 bar, 3 bars, all bull bars, and then you start getting breakout bars, there's a sense of urgency, and that's usually a sign that you're at the start of what will become a strong bull trend. First 11 bars, traders bought at or above the low of the prior bar. They were not even waiting for pullbacks. Everyone was so eager to buy that they were buying at the market, at the close of the bar. They were hoping to buy below the low of the prior bar, but the market for 11 bars did not trade below that prior bar's low. When you have a lot of urgency on the open like this, a very strong breakout lasting about an hour or so, the market then usually goes sideways for several hours and then decides between trend reversal down and trend resumption up. Here, the market was in a trading range for 3 hours. At the end of the day, we got a little trend resumption up. When you're trading the Forex market, the open is rarely ever exact. Some days the move, for example, in the United States session, it might begin at 5:30. Other days it might begin at 6:30. Other days 5 o'clock or 4:45. So when I'm talking about a trend from the open, I'm usually talking about a market that has a single session and a clear open, like the stock market or the day session of the E-mini. I usually do not use the phrase trend from the open when I'm referring to the Forex market or any other 24-hour market. These are open basically 24 hours a day, and the sessions overlap. And the start of the sessions is usually not the same every day. There's often a breakout on a report around the start of the session, and I end up using some other term to describe the trend. For example, here I would just simply call it a breakout. We have a bull breakout and then a channel. For me, this is a bull spike and channel pattern. And it was also a small pullback bull trend. The pullbacks were very small. Rather than calling this a trend from the open, I would call it a spike and channel bull trend. The Forex market really only has one clear open a week, but it has 3 sessions every day. Each of the 3 sessions can have a trend from the open of the session, although that open is not necessarily exactly the same time every day. For example, here, for the euro versus the dollar 5-minute chart, the start of the session usually corresponds to the start of when financial markets start to get active, and that is around 5:30 in the morning Pacific time, 8:30 in the morning Eastern time. When you get a big move like this, you can call it a trend from the open, bear trend, but since it can begin at different times on any given day, I would rather simply call it a breakout. Here's again the euro versus the dollar, and here's the start of the European session. A tight trading range, a pretty unremarkable start. However, it became the high of the session. You have a small bear bar and very bad follow-through. There's some hesitation on the open, some lack of certainty. It could still be a trend from the open bear trend, even though it's beginning with very quiet two-sided trading range type of price action. If I were to use the phrase trend from the open in this market, I would call this a trend from the open bear trend. And it's still trending down from the open, even though it's sideways, and then it's starting to enter a tight bear channel, a much stronger bear trend, a breakout on a higher time frame chart. We have a 9-bar bear microchannel. 5 of the bear bars have big bodies, and they close near their lows. And there are 3 consecutive strong bear bars here. So this is the beginning of what will probably result in at least some kind of a measured move down, maybe based upon the height of this breakout, takes us down here, maybe further. In fact, it did go further. Do you want to call this a trend from the open bear trend? Here's the start of the US session. You can. I would simply call it a tight channel bear trend or a breakout on a higher time frame chart. In any case, it's a strong enough trend. 9-bar bear microchannel, several strong bear bars. The odds are we're going at least a little bit lower. The bears are eager to sell. They're not waiting for pullbacks. They're selling before there is a pullback. So they're not trying to sell above the high of the prior bar. They're selling at the market. They're selling bear closes. They're very eager to sell. And if everybody's eager to sell, chances are, even a small pullback, traders will be eager to sell it. They were willing to sell even without pullbacks. And when they finally do get a pullback, you know the odds are high that rather than a reversal up, it's going to be a bear flag, and that will probably go at least a little bit lower. I now want to talk a little bit about trending trading ranges, a trend made up of a series of trading ranges. When I see a trading range like this on the open of the market, and the trading range is about half of the height of an average day's range, I'm assuming that today's range will be like an average day's range and that the range will double. It can double by going up for a measured move. It can double by going down for a measured move, or it can double by going a little bit down, a little bit up, a little bit down, a little bit up, and remaining a trading range day. When a day does become a trending trading range day, you have an initial range, about half of an average day's range in height, and then you have a breakout. And the breakout is usually fairly brief, sometimes a single bar, sometimes 5 bars, sometimes 6 or 7 bars, but it's brief, and then the market starts to enter another trading range. And this is a good example of a trending trading range day. We have a trading range, a brief breakout for a few bars, and then another trading range. 60% of the time, when you have a trending trading range day like this, in this case we have a bear trending trading range day, the market comes back up at least a little bit into the other range. A bear trending trading range day, I'm expecting that the market will at some point come at least a little bit above the bottom of the upper range. 60% of the time that happens. 40% of the time it does not, and the market either stays sideways or goes down for another leg. Like all trading ranges, once you have a trading range, you got to be thinking breakout mode, and the breakout can go in either direction. Here we have a trend reversal. So bear trend, a trading range, bear flag, but instead of a bear breakout, we're getting a bull breakout. In general, once the trading range extends for about 20 bars, this one's a little bit less. Once it extends for about 20 bars, the probability of the bull breakout is just as high as for the bear breakout. It's basically a 50-50 market. Again, 60% chance that the lower range will come back above the bottom of the upper range by at least a little bit. The breakouts, when you have a trending trading range day, usually last 3, 4, 5 bars, 6 bars, and then you start to get signs of another range. You can see here we have a couple bull bars, and then a bear bar, a bull bar, and then dojis. Looks like at this point we're probably going to enter another range, and the day will be a trending trading range day. Once you get a 20-bar trading range, there's a 50-50 chance that you'll get a downside breakout, a trend reversal, 50-50 chance you'll get an upside breakout, trend resumption. The market is searching for a fair price. It's trying this, and traders decide that the price is too low, so we rally up in a pretty strong bull microchannel. And the rally is a search for sellers. Not enough sellers here, the market has to go higher to find sellers. I said 60% of the time, the range overlaps the range before. Well, look at this. The bottom of this range did not overlap the top of this range, and that's a sign that the bulls are a little bit stronger. However, we got this breakout and formed another range. The upper range did overlap the lower range by a little bit. Every time you get a reasonably strong breakout, the market is telling you that the price is still too low. It has to find sellers, and it has to go higher to find them. Again, I mentioned that in this particular case, even though there's a 60% chance the range will overlap the prior range, there's a 40% chance it will not. And here we have a gap, the top of the lower range and the bottom of the upper range. A sign of strong bulls. The bears were unable to close the gap, and it increases the chances that we're going higher. So when you're starting to get this breakout, you have to assume there's actually better than a 50-50 chance that the breakout will be successful. Here we do have overlap. The third trading range overlaps the second, and it's a sign that the trend is weakening. Strong bear breakout, bear microchannel, a lot of consecutive bear bars closing near their lows. Chances are we're going at least a little bit lower. Maybe this is a little bit lower, maybe this is a little bit lower. But big down, big up, probably trading range. And then we have another bear breakout lasting a few bars. In fact, only 1 or 2 bars below the low of the upper range. As usual, 60% chance the top of the lower range will overlap the bottom of the upper range by at least a little bit. And after 20 or 30 bars, it's in breakout mode, and you can get trend resumption down or trend reversal up. The probability of the two is about the same after about 20 or 30 bars. In this particular case, the market decided that the price was too low and had to go higher to find sellers. And this is common. At the end of the session, the market decides, will the bear trend resume? Will it reverse like it did here? Or will it simply continue sideways into the end of the day? You can see videos on trading ranges and trading the end of the day for more information about what takes place at the end of the session. Again, the euro versus the dollar, a 5-minute chart. There's actually a wedge bottom here. Can you see it? 3 pushes down, 1, 2, 3. I know the second push falls below the line connecting the first and third, but that's common. We have a bear trend, and then late in the bear trend, after 20, 30 bars, here after 50 or 60 or 70 bars, the market enters a triangle. Triangles rarely are perfect, but this is one way to draw it. A high, a second push, a third push. Again, does not matter that the second is above the first. The overall idea is that we're narrowing, we're getting to a narrower, tight trading range, and we have at least 3 pushes up or down. 1, 2, 3. You can argue 3 down. 1, 2, 3. A bull breakout that reversed, and then you can restart the count. 1, maybe 2, and then 3. In any case, it's a breakout mode situation. When you do get a triangle late in a trend, here we got a bear trend, and you get trend resumption, you have to think that the odds are usually 60 or 70% that the triangle will be the final bear flag and that it will lead to a reversal, as it did here. And it did in the form of a wedge. Probably we'll get at least 2 legs sideways to up, 1 pullback 2. I'm finally going to be talking about trends that are in broad channels. We're in a bear trend, and we have deep pullbacks, but in general, still forming lower highs and lower lows. It's a stairs pattern. Here's the breakout, but the pullback goes above the bottom of the breakout. Here's the breakout point, and the pullback goes above the breakout point, and all the way down. Here's the breakout point, and we have a pullback above the bottom of the breakout point. Here's another breakout, and it reversed up back above the bottom of the breakout. And when the pullbacks overlap the breakout points, I call it a stairs pattern. We're stair stepping down. Pullback above the breakout point. Pullback above the breakout point. So that's a stairs pattern. And that's important to recognize. That tells you that bulls who are buying at this low and scaling in lower are making money. And that is a sign of a weak trend and a sign that the market will probably enter a trading range before too long. A broad bear channel always has 20 or 30 bars in it that are also in a trading range. And a lot of times when you look at the chart, you're not sure if it's in a bear trend or in a trading range, or if the bear trend has ended and converted into a trading range. When you're not sure whether it's still a bear trend, a bear channel, or a trading range, does not matter. You trade it like a trading range. You look to buy low, sell high, and scalp. So you buy low, buy in the bottom third, and you scalp somewhere in the middle. On rallies, when they reverse down, you sell them. Since we still are in a bear trend, you can swing trade the sell-offs, the bear entries, but in general, a lot of traders simply scalp them because they're not sure whether the trading range will continue for a lot more bars, and they'd rather just sell and scalp, sell and scalp, sell and scalp. A lot of times when the market is selling off like this, and then you enter a trading range, you're not sure what's going on. Are we forming a wedge? 1, 2, 3. Are we forming a lower low major trend reversal? Are we forming a trading range? We're getting lower highs and lower lows. The answer is all of that. It's obviously still in a bear trend. It's obviously in a trading range, and it's obviously forming a wedge bottom and a lower low major trend reversal. Because it is still in a bear trend, a lot of traders will swing at least part of their position when they're selling. For the longs, we're not yet in a bull trend, so any long is a scalp. So traders taking counter trend positions, here the trend is down, so the counter trend position is buying. A bear trend, so when you're buying only for a scalp. Traders will sell reversals down from the top of the channel. The channel, it rarely is exact. Sometimes on television or on the web, you'll see channels that look perfectly parallel, but that's not how channels typically look. The channels are rarely exact, and you have to keep redrawing the lines. And anytime the market is near the top of the channel, look to sell reversals down. We're in a bear trend, so it's less important to buy reversals up from new lows, although when traders see a lot of two-sided price action and they start to see pullbacks going above breakout points, a lot of traders will buy reversals up from new lows for scalps. 3 pushes down, 1, 2, 3. Second entry for a failed breakout below a prior low, common in trading ranges, so some bulls will buy that at least for a scalp. Double top bear flag and a bull breakout. You can say head and shoulders bottom, left shoulder, head, right shoulder. However, we're still in a bear trend, and you have to be ready for the bull breakout to fail. When you have a double top and a bull breakout that fails, I think of that as a variation of a wedge. We have 3 pushes up, 1, 2 for the double top bear flag, and then the bull breakout is the third push. For me, functionally, this is the same as a wedge bear flag, and I'm expecting at least a couple legs sideways to down. 1 pullback, 2. A reasonable sell, failed breakout above a double top bear flag, another lower high in a bear trend, and a decent sell signal bar. Traders at this point redraw the channel that way. We got a breakout above the channel, another reversal down. Traders will sell below that bar, even though it's a bull bar. We have another double top, bear flag, and a bear channel. A new low, stair stepping down. Traders will buy a reversal up, or they'll simply buy at that low, and then they're willing to buy more lower. Again, when you're buying in a bear trend, or in a trading range, it's better only to scalp. After every reversal down, you redraw the line, and then when you test that new line, traders will look to sell a reversal down again. After every new high, you draw a new line, and you see how the market behaves at that line, and you sell a reversal down here, or a reversal down there. You can draw the line that way, you can draw the line this way, or you can simply say another new low in a broad bear channel, so traders should buy reversals up, or they simply buy at that prior low, looking for a scalp. Bears, they also look to sell somewhere in the middle of the last bear leg. So we have a bear leg. Here's the middle third of that bear leg. Traders will look to sell somewhere in the middle third. For example, a breakout into the middle third, and then we have a bear bar reversing down. So traders will sell below there or below here. Another bear leg starting here or here. This is the middle third. Traders will look to sell somewhere in the middle third. If they get a reversal down, for example, we're breaking out to the upside. Traders will look to sell below the low of a bar, betting that a pullback to the middle third of the prior bear leg will result in another lower high. We're getting lower highs. The same here. Most recent bear leg, traders look for a pullback somewhere to the middle of that bear leg, and then they sell a reversal down, expecting another new low in the bear trend. And bears take profits at the prior lows. So the bears who sell here will take at least partial profits at the prior low. The bears sell here, they'll take profits around the prior low. Bears who sell here, they'll take profits around the prior low. Bulls who buy, they're looking to scalp out somewhere in the middle third where the bears are going short. So for example, a bull who places a limit order to buy at this low, he gets filled. He'll look to sell, take profits for a scalp somewhere in the middle third. And one way to do it is either with a limit order at a certain number of ticks or pips, or simply sell the reversal down, take your profits there. A bull buying at this low sees the market continuing down. However, he's confident that because we're in a stairs pattern, we're going to get back above this breakout point. So some of the bulls who buy here will buy more down here. Their second purchase is at least the size of a typical scalp. Because if it does continue down like this, a lot of them will try to get out around their first entry, break even on their first, and with a scalp on their second. So they want to make sure that that second entry is at least the size of a scalp below the first. So you buy here, buy more here, and then look to exit around the original entry. Bears, they're looking to sell around the middle third anytime there's a reversal down. Here we have a breakout and a pullback below the breakout. A breakout and a pullback below the breakout. So it's a stairs pattern. But what do you notice about this stairs pattern? The size of this breakout from this high to that high is less than the size of the breakout from this high to that high. So the stairs are shrinking. The bulls are less confident that the market's going to continue higher, so they're quicker to take profits. The bears are more confident that it's going to evolve into a trading range soon, and they're more eager to sell. So the height of this breakout is 2 ticks, and the height of that breakout is only 1 tick. It's also 3 pushes up, 1, 2, 3, so a wedge top. When you see a shrinking stairs pattern, you have to be thinking that the bull channel is probably ending and that the market will soon evolve into a trading range. Once it falls below a major higher low, then the pattern of higher lows is no longer still intact, and if the market's not making higher lows, it's no longer in a bull trend. It's either in a bear trend or a trading range. This sell-off is not particularly strong. It does not have consecutive big bear trend bars, and it's finding support at that major higher low. This looks more like a bear leg in what will become a trading range. In any case, it's no longer a bull trend. Here are shrinking bear stairs. That's the size of that breakout. The next breakout is smaller before the bulls come in. Next breakout smaller, next breakout smaller. So the bears are taking profits faster and the bulls are more eager. 17 pip breakout before we get a pullback. Over here, the market only fell 6 pips below the breakout point before we got the pullback. And then we ended up with a double bottom, higher, low, major trend reversal. Head and shoulders bottom, left shoulder, head, right shoulder. The loss of momentum, the loss of strength on the part of the bears means that the bear trend probably is ending and the market will probably enter a trading range or possibly a bull trend. And once you break above a major higher low like this, a strong bear breakout to a new low, so this higher low is major. Once you break above it, the market is no longer in a bear trend. It's then either in a trading range or in a bull trend. And at this point, you can say, wow, that's a bull trend. Well, not necessarily. We're still below the top of the bear trend, and this might simply be a bull leg in a trading range. In any case, it's no longer a bear trend. Here's a daily chart of the euro versus the dollar. Again, a trend continues as long as it's making major higher lows. We have a series of higher lows and higher highs, so we're in a bull trend. But we're getting very deep pullbacks. And some of the pullbacks are strong enough so that traders would conclude that the market is always in short, no longer always in long. Yet, we're still forming higher lows and higher highs. So even though there are times when the reversals down are enough to make traders believe we're always in short, the big picture is we're still in a bull trend. When you have a bull channel with very deep pullbacks, strong bear pullbacks, but we're continuing to form new higher lows, it's a broad bull channel. The bulls are looking for pullbacks to the middle third or so of the prior bull leg, and they'll look to buy in the middle third, or they'll buy a reversal up. Here, a bull trend, a bull leg. Here's a pullback into that middle third. Bulls are looking to buy here. Another leg up. This is the middle of that leg up. The bulls are looking to buy somewhere in the middle of that last leg up. Higher probability of profit if traders are buying above a bull bar, or after a second leg down. So 1 pullback, 2, micro double bottom, small bull bar. Higher probability buying above that. 2 legs down, 1 pullback, 2. Does not really look like 2 legs, but it is 2 small legs. And then 1 pullback, 2. Maybe this is already 2 legs, double bottom. So it might be 1 and then new high, but part of the correction from this high, and 2 legs down. But anyway, it's a double bottom in the middle third. Traders will buy a reversal up. Micro double bottom, they'll buy a reversal up. wedge bull flag, 1, 2, 3, they'll buy a reversal up. We're still in the middle third, they'll buy a reversal up. And bulls are taking profits at new highs. You know that because the market is going down. The market makes a new high and it goes down. That means traders are selling. Bulls are selling to take profits. Bears are selling to go short. Even though the breakout here was strong, look what happened. The pullback eventually fell below the top of the breakout. And that's telling us that it's okay to start selling at new highs using wide stops and scaling in. Bears sell new highs for scalps. Here, they probably would sell more here and get out break even on their first entry with a profit on the second entry. Here, it immediately went down, so they simply scalp out somewhere in the middle third of the last bull leg. Here, a bear would sell, it keeps going up, sell more, and then try to get out, break even on their first entry, and then with a profit on their second entry. If they sell at the prior high and it immediately goes down, they simply take their profits somewhere in the middle third of the most recent bull leg. Same here. They sold, did not go up high enough for them to scale in, but it did pull back into the middle third of the most recent bull leg, and they took profits. In this video, I talked about 3 types of trends. A trend from the open trend, a trend that begins on the first bar or second or third bar of a session. I next talk about trending trading range days, where early in the session there's a trading range, but the trading range is only about half of the height of a typical daily range, so traders expect the range to double. And finally, I talked about broad channels. For example, a broad bull channel has deep pullbacks, and sometimes the sell-offs are so strong the market is always in short, at least for a little bit, yet it reverses up from a higher low. So the series of higher highs and higher lows continues, and therefore the market is in a bull channel, which is a type of bull trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on trends. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on trends. In this video, I'm going to be talking about tight channels, which are strong trends, and I'll also talk about small pullback trends, which are the strongest types of trends. Sometimes you see a trend like this, we got a spike up and then a channel, and it's difficult to know if this is still part of the breakout phase or if it's part of a channel. On a higher time frame chart, it is part of a breakout, and if it's difficult to tell whether it's a breakout or a tight channel, assume it's a breakout and trade it like a breakout and only look to buy. Because it is a breakout on a higher time frame chart. And it's clearly a bull trend, so you should only buy. Can you sell? I would only buy. Whenever the market is in a fairly tight bull channel, it's a breakout on a higher time frame chart, it's much easier to make money looking to buy. The odds of making money as a bear are small, so better only to look to buy. So let's say this is a 5-minute chart, and it's a fairly tight bull channel. A tight channel is weak compared to a breakout, but it's still a pretty strong bull trend. The pullback only lasted 1 bar. Pullback only lasted 1 bar. Here, no pullback at all. Even if you do get a reversal, it's probably minor, and you're probably going to get at least a little bit more up. So I think of a tight channel as a strong trend, and I trade it like a breakout. And as I said, on a higher time frame chart, it is a breakout. So for example, 5-minute chart, this green box here, this green box is the same bars, but this is a 15-minute chart, and it's clearly simply a strong breakout, and you don't want to be selling. So you only want to be trading in the direction of the breakout. Tight bear channel, the pullbacks are small, they're not going very far up, and the channel down is very tight. It's a breakout on some higher time frame chart. There are always different ways to draw the channel. This is one way. You can also draw it that way as well. And it does not matter. When the pullbacks are small, you only want to be looking to sell. And here we get a gap this low, these highs. The market's forming gaps, but you only want to be selling. And if you want, you can sell with stops on reversals down. So you wait for a reversal up to fail, and then you keep looking to sell below the low of the prior bar, betting that the bull reversal will fail, and that the bull reversal, in fact, will simply be a bear flag. Here, you sell. Does not matter if this goes above that. We're still forming lower highs, major lower highs. This is a minor lower high, minor lower high. So it does not matter that we go above it. Traders should only be looking to sell when the channel is this tight. It's a breakout on a higher time frame chart, so you only look to sell. And these gaps that we're getting are a sign that it's a very strong bear trend and you should not be buying. Bull breakout, a channel. We have pullbacks, we have some bear bars, but the pullbacks only last a bar or so and they do not fall very far. And on a higher time frame chart, it's a breakout. Many ways to draw the channel. This is one way, and you can also draw it like that. And the channels, they're never perfect, they're rarely perfect, doesn't matter. When the channel is very tight like this, only look to buy. Every time you see a reversal attempt, expect it to fail and become a bull flag, and then buy with a stop above the high of the prior bar. Gaps, we have a reversal attempt, but the low of the reversal could not fall above the high of the breakout point. Again here, bull breakout, tried to fail, tried to reverse here, but these bars held above the breakout point, and that is a sign of a very strong bull trend, so you do not want to sell. This is unlike a broad channel, where the pullbacks last 5-10 bars or more, and sometimes the breakout is strong enough to make the market always in short. So we get a big breakout bar and a follow-through bar, probably always in short, but we're still getting higher lows, and this still could be a broad bull channel. A broad channel like this, to me, is basically a trading range that's sloped upward, and you can trade both as a bull and as a bear. But because it's a bull trend, in general, it's easier to make money buying. It's also a pair of trading ranges. We had a trading range, and then a breakout and another trading range. And that's often the case. That's usually the case whenever the market's in a broad channel. It's usually also spending a lot of time in trading ranges. Trading range, two-sided trading, traders tend to buy low, sell high, and scalp. So whenever the market is in either a trading range or a broad channel, traders will often trade in both directions, and they'll take quick profits because they believe the market's not going to go very far. So they buy low, sell high, and scalp. So whenever the market falls somewhere in the middle third, they look to buy. Anytime it goes to a new high, they look to sell. And they take quick profits because they believe the market's not going to go very far. So you got a bull channel. Is it tight or broad? Now, sometimes you're in that gray zone where you don't really know. Here we got a 2-bar pullback, well, 1-bar pullback here, 2-bar pullback here, a little trading range here. Is it a tight channel or is it a breakout? On a higher time frame chart, it's probably a breakout. But whenever I'm looking at any chart and I'm deciding broad or tight channel, I always assume tight, and therefore I only want to look to buy until there's more evidence that the market is two-sided. If you cannot tell broad or tight, only look to buy, like in this example. So every time the market tries to reverse or pause, look to buy with a stop as the market reverses up. Small pullback trend, the strongest type of trend. And it usually is also some other type of trend as well, like a trend from the open, a spike in channel trend. A lot of times there are small trading ranges, so it's a trending trading range day. And the pullbacks, I said it's a small pullback trend, so the pullbacks are small. They typically do not fall very far, and they typically do not last many bars. So 1 bar here, 1 or 2 bars here. We're getting reversal attempts, and a lot of the rally in a small pullback bull trend looks like a bull leg in a trading range. You're not getting consecutive big trend bars. You're getting bars with a lot of hesitation, tails on top, bear bars. And that is a warning that either it's a bull leg in a trading range, or if he's trying to get gaps or negative gaps, pullbacks just dipping a little bit below breakout points, or not dipping below at all. Even though it looks like a bull leg in a trading range, it's probably a small pullback bull trend, and it's probably going a lot higher. So a pullback's just lasting a few bars, no consecutive big bear bars. The pullbacks are all less than twice the size of an average bar. While any type of trend can begin any time of the day, small pullback trends usually begin in the first hour or so. And again, the pullbacks are less than twice the size of an average bar. And one of the most important characteristics is gaps and negative gaps. So once you start to see a rally that looks weak, it lacks consecutive big bars, but it's forming gaps, you got to be thinking, uh-oh, this is one of those small pullback trends that Al talks about, and it's one of the strongest types of trends, and therefore I should only look to buy. And these trends are breakouts on higher time frame charts. So here's a 5-minute chart, small pullback bear trend, and this is what it looks like on a 30-minute chart, a higher time frame chart. Almost all bear bars, mostly a bear microchannel, so it's a bear breakout. Each of these pullbacks means that it's a channel on the 5-minute chart, but the absence of pullbacks on the 30-minute chart means that it's a breakout. Because this channel is a breakout on a higher time frame chart, the 5-minute chart is much stronger than it appears. A breakout is the strongest type of trend, and it usually leads to some kind of a measured move. If you have a small pullback bear trend, you know it's a breakout on the higher time frame charts, and you know it's therefore one of the strongest types of trends, even though most of the time it keeps looking like it's a bear leg in a trading range. These gaps that I talked about are really important. They make it likely to be a small pullback bear trend rather than a trading range. So look at this. We got a breakout here below this breakout point, did not overlap. And we got a breakout here, did not overlap. The pullbacks are not going over the breakout points. And that is one of the hallmarks of a small pullback trend. If you're getting gaps, especially if you get 2 or 3 gaps, that's a warning that even though each little part of the trend looks weak, it's a very strong trend and the market's probably going a lot lower. So do not look to buy. You certainly don't buy until you start seeing some transition into a trading range. You need to see some sign of strength on the part of the bulls. The bulls need to start closing gaps, like here. The breakout point, here's the breakout point, the pullback went above the breakout point, so maybe the market will soon begin to transition into a stairs pattern and then a trading range. In these very tight bull channels, small pullback trends, the market's always trying to reverse, but the breakouts will fail and become bull flags. And usually later in the day, after 3, 4, 5 hours of trading, if you're trading stock index futures, a lot of times around 11 o'clock, 10 o'clock, sometimes 12 o'clock, but usually around 11 o'clock, 11:30, you get a breakout that is 50% to 100% bigger than the biggest prior breakout. So here's the biggest prior breakout, and then here we got one that's about 50% bigger. And it's an attempt by the bears to take control and reverse the market late in the day, but chances are the bears will fail and the reversal attempt will become a bull flag, and a lot of times it goes up to a new high at the end of the day. We have a very strong breakout, another breakout, and then a very small pullback bull trend. You can call it simply a tight channel. Sometimes you get a bigger reversal late in the day. This is so extremely climactic, it's not a surprise. And sometimes you get a sell-off into the end of the session or into the close of the day. You know, here we're sideways for 20 or 30 bars, and now we got a double top major trend reversal, and we just sold off slightly into the close. Sometimes you'll get these small pullback trends, and they actually will reverse. Here we got a spike and channel, maybe a parabolic wedge, 1, 2, 3, nested, 1, 2, 3, and then you start to get an endless pullback in a tight channel like that. You're going to be thinking that the market might be seeing this as a parabolic wedge, and if it does, a lot of times you'll get a breakout after 20 or 30 bars, and then you convert into a bear trend. We got a bear breakout, bear follow through. You can say, well, Al, these are gap bars. There's a gap between the high of the bar and the moving average. Won't that lead to a test of the bull trend high and then a major trend reversal attempt? Well, it typically does, except that this endless pullback and a tight bear channel has gone on for 20 or more bars, and that's making the market pretty neutral. So this bull reversal may not get very far. You can see the bad follow through in the market failing to break strongly above the moving average. Is it now a small pullback bear trend? Usually I don't think of it that way. So I think of a small pullback bull trend and then an endless bear pullback. But to me, this is a real problem for the bulls. This is so climactic, unsustainable. And now we have an endless pullback and a bear breakout and a reversal up. Could not get above the top of the bear breakout. This might be the start of a bear trend, this bear breakout bar. So you got to be ready if the market starts to sell off, especially once you get another bear bar and a bear follow through bar. Traders start to sell closes and they sell above bull bars, betting the reversal up will fail. Usually, if you have a small pullback bull trend, you do not get a reversal. This is really more of a spike and channel bull trend or a parabolic wedge bull trend and less of a small pullback bull trend. I typically don't call this a small pullback bull trend, although it clearly is. To me, it's just so climactic and so extreme, I think of it more as a biclimax. Remember, I said that small pullback bull trends, typically, they have weak bars, a lot of doji bars, prominent tails, bear bars. It looks like a bull leg in a trading range. That's not the case here. This is much more of a parabolic biclimax, parabolic wedge biclimax. This is more of a small pullback bear trend. We got a lot of bars with tails. We got some gaps. Does not look especially strong. No big bear bars. We're getting bad follow through bull bars. But here we got a bull breakout and a higher low. So it's possible that this is a higher low major trend reversal, and this is maybe a final bear flag, low too short, 2 legs up, 1 pullback 2, so a low too short and a wedge bottom, and then a higher low major trend reversal. So possible start of a reversal up, which we got. Less common after a small pullback bear trend, but you still can get it. Higher low major trend reversal. Some will say this is the higher low major trend reversal. This is a double bottom with this bear bar. Other computers will say the double bottom is here. So it's a double bottom higher low major trend reversal. Small pullback trends are also tight channels. That only makes sense, right? If the pullbacks are really small and the market's trending higher, it's going to be in a tight channel. Pullbacks are usually less than 2 to 3 times the size of the smallest scalp. Here we have a bigger pullback late in the day. Usually it fails and you get trend resumption up. And you redraw the channel. So we have a tight channel here, we broke below it, and now the market's resuming up. You redraw the channel, and the distance between the lines is now greater. Channels as they mature, trends as they mature, typically become weaker, and the channels tend to become broader and flatter. So flatter, the slope of this new channel is less than the slope of this original channel. Whenever you think the market might be in a fairly strong bull trend, do not sell. Here we got a bull breakout. Do you want to sell for a failed breakout? I would not. Not yet. A lot of the beginners like to sell in bull trends because the stop is close, but they ignore probability. And whenever you're taking a trade with a low risk, a small risk, chances are you're going to lose. The probability is going to be low. And if you get enough of those small losses, 3, 4, 5 small losses, it can add up to a pretty big loss. So whenever you're in a market where the pullbacks are very small, even if you see a lot of weak looking bull bars, do not sell, because on a higher time frame, it's a bull breakout. So if a trader sells here, he gets stopped out. Trader sells here, he gets stopped out. Trader sells here, probably will get stopped out. A lot of bulls are afraid to buy because the rally looks weak. Tight trading range with dojis, bull bar bad follow through, bull bars with dojis, the bull breakout not all that big. So bulls end up getting trapped out. At least weak bulls do, because they know where their stop is. The stop is way down here, so they don't want to be buying too far up in a rally that looks weak. But if the market is forming gaps and not much in terms of bear bars, it's perfectly good to buy for any reason and just use the appropriate stop. Beginners, they just look at the dojis and say, oh, strong bull trends do not have all these dojis, so it cannot go higher. In general, that's true. Breakouts do not have all those small dojis, but small pullback bull trends, they do have a lot of small dojis, and the market is in one of the strongest types of trends. You don't want to be selling. The wider the stop you use on any trade, the higher the probability is that you make money. When you do lose, you obviously lose more than with a tight stop, but as a general rule, if you use wide stops, you're increasing your risk, but you're doing that to increase your probability. So wide stops usually mean higher probability. Tight stops usually mean low probability of making money. So you know where the stop is. Initially, it's down here, and then you see a bull breakout or somewhere up here, you raise the stop to here. After you see 3, 4, 5 bars up, strong breakout, this becomes a major higher low, so you raise the stop. The strong bulls, they see the doji bars and they see the bear bodies, and they know the trend does not look all that strong, but they also recognize it as a small pullback bull trend day. They see gaps and negative gaps with a lot of trading range price action, and that usually means the market is going to go higher, small pullback bull trend. And they buy for any reason. You can buy reversals up from bear tops, you can buy stop orders, you can buy at the market, and then every time you get a reasonably strong breakout, especially with follow through, you tighten your stop to just below the breakout or just below the most recent higher low. Strong breakout, move the stop from here to there. Bulls buying above these bars, betting on a bull flag. Once you get this breakout, you raise the stop, and this becomes a major higher low. Major because it has both decent bull bars and it's a new high. One other thought about this is the best looking bull bar probably. We got one comparable here, but certainly one of the best 1 or 2 bull bars, and it's occurring late in a bull trend. So that's an increased risk of exhaustion. Exhausted bulls do not necessarily sell enough to create a short, a bear trend. Usually they do not. However, they usually do sell enough to create a trading range. So if you start to see a surprise bar like this late in a bull trend, 30, 40, 50 bars, it's an opportunity to take profits. Sometimes when you get these small pullback bull trends, they stay above the average price for a lot of bars. This is maybe 30, 40 bars above the moving average. That means bulls are really aggressive. They're willing and eager to pay above an average price for 20 or 30 bars. So what do you think will happen when it finally gets down to an average price? Well, the bulls will buy. They've been buying above an average price for a lot of bars. So if they finally get a chance to buy at the moving average, they usually take it. Also, whenever the market's above the moving average for about 20 bars or more than 20 bars, I think of it as a 20 gap bar buy setup. And a lot of bulls will place limit orders to buy the moving average, at least for a scalp. Also, a lot of bulls will look for the first bear close below the moving average, and they'll buy that bear close, betting that it's a trap, and it usually is. So here you have a 20 gap bar buy. You can buy the moving average or place a limit order to buy one tick above. Or you can buy these gap bars, betting that the trend is so strong, we will resume up to a new high. Bulls, as I said, try to buy the first bear thing. So the first time there's a pullback below the low of the prior bar, they buy it. First time there's a break below a minor higher low, they buy it. First test of the moving average, they buy it. First bear close below the moving average, they buy it. First big bear trend bar below the moving average, they buy it. Gap bars, as soon as they see bars with a gap between the high of the bar and the moving average, they buy. They can either buy the gap bar or they can buy the reversal back up using a stop. And here we have a moving average gap bar, a gap between the high of the bar and the moving average. So bulls will buy on a stop just above the high of that bar. And even though we're getting a lot of sell-offs here, we're still making higher lows and higher highs. Gap bars, it's a sign that the bulls are losing control, and it's a sign of strong bears. They're able to put a bar completely below the moving average. So when you get gap bars in a bull trend that's going on for 2 or 3 hours, the rally that follows the gap bars usually will be the final rally before the market attempts a major trend reversal. E-mini, trend from the open bull trend, very strong bull breakout, pullback, and then we're just moving up. Again, when it's this strongly up, I tend to think of it more as just a breakout and an extended breakout on a higher time frame chart. I also am aware of the possibility that it could be a parabolic wedge top. Small pullback bull trend, also a trend from the open bull trend, and spike and channel bull trend. So spike, pullback, channel, or the whole thing is a spike, pullback, channel. Again, most trends have a spike and channel trend within them. First pullback in about 15 bars or so. First pullback in about 15 bars or so. Bulls will buy it. And pullback, you're going to be thinking that the channel will follow. And here we got a 14 tick pullback. And the first pullback to the moving average in about 50 bars. Small pullback bull trend. You always look for a bigger pullback later in the day. Usually about 50 to 100% bigger. Here we got a 14 tick pullback, and here we have a 31 tick pullback. A lot of bars that do not look particularly bullish. A lot of small bars, a lot of dojis, a lot of prominent tails. The lack of consecutive big bull bars closing on their highs. One of the characteristics of a small pullback bull trend. And then, most importantly, in addition to seeing weak bars, I want to see gaps, at least one or two. A pullback held above a breakout point, and again here, that's a sign of very strong bulls, and it increases the chances that we'll get some kind of a measured move up. In fact, here, measured move from the bottom of the bull trend to the top of this rally takes us up to about the high of the day. So from the low of the day to this breakout point, measured move up. This is the euro versus the Canadian dollar, and this is the approximate start of the Asian session, and it began as a small pullback bull trend. A lot of weak-looking bars, dojis here, not particularly big bull bars here, a lot of reversal attempts, but it's still a small pullback bull trend. A lot of dojis common in small pullback bull trends. But look at the size of the pullbacks. 13 pips, 17 pips, 22 pips. They're all pretty small. The entire rally went up 115 points, and the biggest pullback was only 22 pips. So very small pullback in the bull trend. A lot of dojis, a lot of prominent tails, the absence of consecutive big strong bear trend bars. You have to be thinking about small pullback bear trend. Next, you look to see if there are gaps. And if there are gaps, the day is probably a fairly strongly bearish day. I always measure the size of the pullbacks. So 17 pip pullback here, 19 pips here, 14 here. And here we fall 140 points. And the biggest pullback was only 19 pips over here. Again, lots of dojis. It looks like probably a bear leg in a trading range. But once you start to see gaps, you got to throw out that idea of a bear leg in a trading range. And instead, you have to assume small pullback bear trend and that we're going to work lower. One of the hallmarks of a small pullback trend is gap formation. So if you start to see gaps, yet the bars do not look particularly strong, you have to assume that the market is much stronger than what you think. Again, you can see we have a gap. It became the measuring gap. And a lot of the bulls got out here, even though the market continued sideways for a couple of hours. In this video, I talked about tight channels and how they are breakouts on higher time frame charts. You only want to be buying in tight bull channels. You only want to be selling in tight bear channels. Next, I talked about small pullback trends, which are typically one of the strongest types of trends, and they can last a long time. They always look bad. They always look like they're forming legs within trading ranges. But once you start to see gaps, even if the gaps are not particularly impressive, you have to assume that it's a small pullback trend and not a leg within a trading range. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on trends. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on breakouts. I'm going to begin by talking about exactly what I mean by a breakout. I'll then talk about my 80% rule, and that is in part that 80% of breakouts fail. Next, I want to make a point about every reversal being a breakout. And finally, since breakouts fail in a trading range, traders need to buy low, sell high, and scalp. A breakout is simply a trend bar, or a series of trend bars. So every trend bar that you see on the chart is a breakout, and sometimes you get a series of trend bars and they form a breakout. Bear breakout there, bull breakout here. It can be one bar, and it can grow into several bars. A breakout always is a move beyond some kind of support or resistance. If you have a bull breakout like this, there are several resistance levels that the market is breaking above. First of all, the high of the prior bar is always resistance. Next, you have a lower high. Next, you have a trend line. Next, you have the moving average. Here, we had a double bottom in a bear breakout. Small head and shoulders top, left shoulder, head, right shoulder, and it failed. And the bulls were able to get a micro double bottom. So the bears tried to sell off, and the bulls bought. The bears tried to sell off again, and the bulls bought even more aggressively, creating a good buy signal bar. In this particular case, the market broke below a double bottom, and then it broke back above. So that is a breakout back above a double bottom. As breakouts grow, they tend to go above higher and higher resistance levels in the case of a bull breakout like here. At this point, it broke above the moving average and finally got a close above the moving average. I always look at trend lines, and there are different ways to draw them. I could use these two highs, or I could use this high and that high. And clearly, the market is breaking above the trend line as well. So the market's breaking above a bear trend line. I said that it broke above the high of this bear bar, but I also look at prior lower highs in a bear trend. And the more resistance that the market breaks above, the more likely the breakout will have follow through and a second leg up or multiple legs up. So we're breaking above a prior lower high. And then we broke above another lower high. At this point, you can call this a trading range. Every head and shoulders top, left shoulder, head, right shoulder is a trading range. Maybe the trading range began here. We went down, we went up, we went down, we went up, down, up. It's a lower high, but it's also a trading range. So we broke below the range, and then we broke above the range. My 80% rule is that markets have inertia, and 80% of the time they resist change. So 80% of the time, if the market's in a trend, reversal attempts will fail. And 80% of the time, if the market's in a trading range, breakouts will fail. And that is the reality. So the market broke above this low, reversed up, broke above this high, reversed down. And it's just repeatedly reversed breakout attempts. New high, failed. New low, failed. We tried to reverse up, failed. Broke to a new low, failed. Broke above this high, failed. Above this high, pulled back. This high, we pulled back, tried to reverse down, tried to fail. Here we tried to reverse down, and we succeeded. We broke below the bottom of this strong rally. But the breakout failed. Also, a really important point about breakouts is that on any chart, any time frame, only about 10% of the bars will be in a strong breakout that actually has follow through. So you can look at this chart, maybe it has 100 bars on it, and we have a few bars down here, a few bars up here, a few bars down here, and a few more bars down there. But only 10% of the bars actually have follow through. So this sell-off had a little bit of follow through, this buying had a little bit of follow through, this sell-off had a little bit of follow through. Most of the bars, 90% of the bars on the chart, are either in channels or in trading ranges, even if the bars are pretty big trend bars. When the market's in a channel or a trading range, 80% of the breakouts will fail to get very far. On this slide, we have a pair of pretty good bull bars, especially this bar, followed by a bear bar. And then we have a bull flag, a 1-bar pullback. You can call it a 2-bar pullback. We started the pullback here. This bar pulled back below that bar, so this is technically a pullback on this time frame. And it's about a 50% pullback, and it's a bull bar. Tail on top, following a big bear reversal bar. Not a high probability buy, but the market's still always in long at that point, and it is a high 1 bull flag, so it is a buy setup. But bull flags like this very commonly have breakouts that fail and reverse down. So a lot of traders will buy on a stop just above the high of this bar, taking a chance that if the breakout is not successful, maybe we'll pull back for another bar or two, hold above this low, and then resume up with a high 2 or a high 3. As I said, this is a high 1 bull flag, but a pretty prominent tail above and a prominent tail below. The body is less than half the height of the bar, so I would call that a doji bar. And if the bulls see this bar, their entry bar, they're going to be disappointed. They don't want to see a bear bar, and they don't want to see a bar closing below its midpoint. Well, that tells us that in this particular case, there probably were more sellers above the high of this bull flag than buyers. Bears will see that, and instead of buying this breakout, they'll sell it. The bears are betting that most breakout attempts will fail, and that this is a fairly decent reversal after a small 2-bar breakout, and it's a bad-looking buy signal bar. At a minimum, it's possibly a reasonable scalp, betting that the breakout, the first reversal up from the pullback, will fail. Here we have a bull breakout and an attempt to make the breakout fail. And by this bar going below the low of that bar, it triggers a failed bull breakout. A lot of traders will sell on a stop below that bear bar, betting that the bull breakout will fail and reverse down. A lot of traders will sell that, betting that the bull breakout will fail. Now remember, every reversal is a breakout of something. So we have a bear bar, and you should think of it as a breakout as well. If I were to draw a trend line up from the low of this bar to the high of this bar, it would be vertical. Or I could draw a trend line from the low of this bar to the high of that bar, and it would be a trend on a smaller time frame chart, and this bear bar is a reversal down. My point is that whenever I see a reversal down after a bull breakout, I think the reversal down is a bear breakout. I think of it that way. I think of it as if there was an obvious breakout here. Clearly, there's not an obvious breakout here, but it's a reversal attempt, and I think of every reversal attempt as a breakout. Now, which breakout is stronger, the bull breakout or the bear breakout? Clearly, the bull breakout is stronger, and therefore it's not a particularly high probability sell below that low. Bears will take the sell, taking a chance that will just keep going down, knowing that the probability is low, but the risk is low as well. They're putting a stop above the high of the bar or above the high of the bull breakout and taking a chance that it's the start of a big bear trend. Low probability, great risk reward. This bear bar might not be strong enough to reverse that. So there might be more buyers than sellers below the low of this bar. And clearly, if you're a bear and you shorted, you do not like the bull close. You do not like your entry bar failing to become a big bear bar closing on its low. So a lot of bears are disappointed. Bear trend tried to resume down again here, and they have a bear bar, but a much weaker bear bar, big tail on the bottom of the bar. So we had a bear bar here, tried to get a bear breakout, got a bull bar. We had another attempt at a bear breakout, could not close below the low of the prior bar, just like this could not close below the low of that bar. And here we have a close at or above the midpoint of the bar. So this is not a very good looking breakout. It's telling us that there might be more traders believing the opposite. So the bears sold, betting that the bull breakout will fail, but it looks like there probably were more bulls buying at the low of this bar, betting that the bear reversal would fail, which is logical because most reversals fail, most breakouts fail, most reversals fail. Now, if a trader thinks that buyers will win above or below a bar, he should buy. Look at this rally. We have 3 bull bars. Not great, big tails, but 2 of them closed well above the midpoint, and this one has a pretty good sized body and a close above the high of the prior bar, so there's a gap there. Is this going to be a failed bull breakout? It's a low probability short. There probably are more buyers at the low of this bar than there are sellers. So some bears will sell, looking for a move below here and a measured move down, but probably 3 consecutive bull bars, probably more buyers than sellers below, so probably more traders would buy. However, because of the absence of big bull trend bars closing on their highs, and we have prominent tails, a couple small bars, the bulls know that there might be a deep pullback and a trading range, so it's okay to buy if you use the correct stop. Here, at this point, we have a pair of bull bars, this one closing on its high, and it's a higher low. This is a higher probability buy than there, but both are appropriate buys. So here, bulls thought pretty strong rally, probably buyers below. At this point, they see a higher low with 2 bull bars, and they're thinking that, well, there probably have buyers above this bar as well. So buyers below that bar and buyers above this bar. A seller, the exact opposite. If he thinks that the sellers will win, he should sell. So for example, he might say, not a very good rally. The buy signal bar has a pretty prominent tail on top. We have a micro double top, up and down, up and down. Maybe we'll enter a tight trading range. Maybe I'll sell above the high of this bull bar. It has a fairly prominent tail, and I'll sell there. And maybe I'll sell below this bear bar. Now we have another version of a micro double top or a micro triple top. Up, down, up, down, up. And if we're going down again with a bear bar closing on its low, it's a second entry sell for the failed bull breakout. Bull breakout, first entry sell. And then we went up again. Now we have a better looking sell signal bar. That is a higher probability short than selling below that bar. So you have bears selling above this bar and selling below that bar. A lot of the time, if not most of the time, traders are fairly uncertain what to do. That's the nature of markets. They strive for confusion. And if at any time you're not sure, then just wait. Should you buy above this bar? Should you sell above this bar? Should you buy above this bar? Sell above this bar? Should you buy or sell below that bar? If you're not sure, best choice is wait. I mentioned examples of support and resistance that can lead to breakouts. Does it matter what type of breakout it is? A break above a prior high or low, a trend line, a moving average? It doesn't matter. All that matters is that there's a breakout. And a lot of times, if you're a beginner, you don't even see what's being broken out. But again, it doesn't matter. If the breakout is strong enough, you don't need to see or understand what's being broken. Remember, every trend bar is a breakout. Every series of trend bars is a breakout. And the bigger the bars, the more they close on their high. If we're talking about a bull breakout, the stronger the breakout, and the more likely there'll be at least a 2-legged move. Here, 3 pushes up, 1, 2, 3. And we have a bear bar, so it's a breakout. It's a reversal. Every reversal is a breakout. And then this is clearly a breakout. But a breakout of what? Of many things. It's a wedge top, so it's a break below the bottom of the wedge. It's a break below the trend line. Here we have a very big bull bar. A lot of bulls will put their protective stop just below its low. So it's a breakout below the bottom of a very big bull bar, a biclimax bar. Here, we have a rally, not nearly as strong as the sell-off, and bad follow-through. We keep getting pullbacks. Here we have a little triangle, a bull breakout above the triangle, reversing down. So this is basically a bear flag. So we have a small early bear trend, and we test it back up. Traders will view it as a bear flag, and they'll look to sell a breakout below the bear flag. They'll also look to sell a breakout below this low, below that low, below the trend line at the bottom of the trend. You can see we're failing at the 60-minute moving average. This is a 5-minute chart of the euro versus the dollar, and we're failing to break above the 60-minute moving average. We failed to get above it here, 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 and then here, and then here, and now we're starting to reverse down again. Bear breakout, tried to reverse up, so a small bear flag, and this is a breakout below the bear flag. Another small bear flag. Then at the bottom here, we have a spike and channel bottom, bear breakout, spike, 3 pushes, 1, 2, 3, so a small wedge bottom after a bear breakout. And then we're trying to reverse up again. Every bull bar is a trend bar, it's a breakout, it's a climax, and this is a little bull breakout above the top of a wedge bottom. Channel is tight like this, probably even a strong reversal up like this is going to be minor, a bull leg in a trading range, rather than the start of a bull trend. That means that the rally probably has to test down. Here, we got a higher low. The bulls are hoping for a trend reversal, not likely when the channel down is this tight. You can see here we broke below that low. But then we broke above this high. Is this a major lower high in the start of a bull trend up here? No, it's not a major lower high. It did not result in a strong reversal down. It did not result in a new low. So it's a minor lower high. A breakout above it probably will not get very far, and it did not. It reversed down on the next bar. Another leg down, another two-legged rally, low 1, low 2, so another bear flag. Break below the bear flag. And then we have a double bottom attempt. We got a bear breakout, so that's a wedge. 3 pushes down. Every double bottom is 1 push, 2 pushes down. If the market breaks below it, that's a third push down, so even though it does not look like a wedge, it's a wedge. And it's a nested wedge because it's within a larger wedge. 1, 2, 3. And then we have a bull trend bar, so we're getting a reversal up. We're trying to break out above a wedge bear channel. Trying to form a micro double bottom. Got a bear breakout. And then we have another attempt at a bottom. We broke below it, but immediately reversed up. At this point, a pretty strong bull breakout, well above the moving average. There are gap bars here, gaps between the lows of the bars and the moving average. And therefore, the sell-off that tests the low of the bear trend probably will be the final leg down before we get an attempt at a major trend reversal. And here we got a higher low major trend reversal and a second leg up. We got a bull breakout and a pullback around 50% bull flag. The sell-off is weaker than the rally. And we have a wedge bottom, so probably 2 legs up, 1 pullback, 2. And this is also a higher low major trend reversal. So bear channel, bull flag, we got a bull breakout. Then we got breakouts above minor lower highs. A double top attempt by the bears, double top, neckline, bear breakout? No. We have a double top, and instead we got a bull breakout. Then we got a breakout above this high. A wedge rally, 3 pushes up, 1, 2, 3. Other ways to count it, 1, 2, 3. In any case, it's a bull channel, and this is a break below the bull channel. Did not get very far. Now we have a bear channel, a bull flag, and this is a breakout above it. Not particularly strong. And then we got another bull channel, and we broke below it. We have an attempt at a higher low, and broke below it. I'm telling you that every trend bar, or series of trend bars, is a breakout. And a lot of times you look at the chart and say, well, I don't know what's being broken out. Well, there's something being broken out. This chart is an example of a lot of little things that are being broken out. And I'm just trying to explain what a lot of the computers are seeing. The computers are looking for breakouts, and these are the kinds of things that different computers look for. Most of them are minor, and most of the breakout attempts fail. A breakout, it can be a single trend bar, and there are many terms for the same thing. You can call this a strong trend, or a strong trend bar, strong series of trend bars, a breakout, a spike, a climax, a gap, a reversal. This could be a reversal. We could have gone down here and then up here. It's all the same thing. Those are all synonyms for trend bars. This is a bull trend bar. Now, which term I use depends on what took place over here to the left. if the market was selling off and reversed up, I would call this a reversal. It's still a buy climax. It's still a bull breakout. It's still a spike. Probably has some kind of a gap between this close and something, the high maybe of the prior bar. But all that really is important is it's a bull trend bar, and so it's a breakout. Even if you don't know what's being broken out, you see a bull trend bar, it's a breakout. Consecutive bull trend bars, it's a breakout. It's a stronger breakout because not only do we have higher price, we have more time. The market has been breaking out for a longer period of time. 3 consecutive bull trend bars. Now we have 3 consecutive bull trend bars, even a stronger breakout. The reversal down, probably minor. It's big enough down, so we have a big up, big down reversal. We probably have to go sideways for a few bars. But this chart is still always in long. Every breakout, no matter how strong, eventually tries to reverse. But most reversal attempts fail. I've said a couple times today that every reversal is a breakout. Again, a lot of times it doesn't look like a breakout, it just looks like a reversal. And it doesn't matter if you call it a reversal or a breakout. There is a breakout there. Here we have a bear trend bar, so immediately think breakout. What did it break below? Well, it broke below this 3-bar bull channel. It broke below the low of this bar. Does not matter. Anytime I see a big trend bar, a bear trend bar, I think breakout. And again, the choice of the term depends on what took place to the left. Here we were rallying, now we have a big bear trend bar, so I would refer to that as a reversal, but it's still a breakout. We have a bull breakout, and this represents a failed bull breakout. Whether that will lead to a trend or a trading range, or a pause in the trend and a bull flag and trend resumption up, too early to tell. But it's a bear reversal, it's a failed bull breakout. I've made this point many times throughout the course, that breakouts are common. Every trend bar, every series of trend bars is a breakout. Lots of bull breakouts. This is a big bull breakout made up of many smaller bull breakouts. Bear breakout, other bear breakouts. Some have 2 bars, some have more, some are just, here's 3 bars. Do I count that as part of the breakout? I typically do not. To me, that's a pause bar, and then we accelerated down, so I would call that the breakout. Markets have inertia. That is my 80% rule. And by inertia, what I mean is the market tends to continue to do what it has been doing. So anytime I see a breakout like this, I look to the left. Trading range. Chances are the breakout will fail, or eventually fail. If I'm looking at a reasonably strong rally, and I see a breakout here, chances are we're going to get some follow-through buying. Because bars to the left, we've had 7 bars up, 7 bull bars. Now, every tail on every bar is a breakout. This tail below, at one point, this was a bear trend bar with a close down here, but by the time the bar actually closed, it became a bull bar. The market traded below this low. We have a bear trend, small rally, bear flag, and it was a break below the bear flag, and it failed. Now we have a low 2 bear flag, and these bars all have tails below. That means they all represent failed breakouts. Tails at the tops of bars, failed bull breakouts. We have a bull flag. We tried to break out, failed. Tried to break out, failed. So every tail is a failed breakout attempt. Trading range breakouts, like I said, the markets have inertia. And if the market has been going sideways, chances are it'll continue to go sideways. And 80% of attempts to have it break out into a trend will fail. 5-minute chart, euro versus the yen. Up and down repeatedly. Here we have a decent bear bar and good follow through at the bottom of the range. At a prior low, we reversed up. Here we have a bull breakout to a new high, and look at the follow through. Strong bull bars trap traders into buying high. Bulls are hopeful. Like you see a bar like this, you say, oh wow, this is clearly going to be the end of the trading range and the start of a bull trend. Well, it's not. Most trading range breakouts fail, even very strong ones like this or like that. Beginners, they tend to buy these bull closes, betting on a successful breakout, forgetting my 80% rule that most fail. Smart bears, what they do is when they start to see strong bull bars, big bull trend bars near the top of the range, they look to sell. They can either sell with stops on a reversal down, like below that bar, below this bar, or a lot of them will look at strong bull closes and sell the market. So as soon as that bar closes, they hit sell the market and they get filled on the open of the next bar. Every breakout is a climax. when it's at the top and a sell climax at the bottom. And 80% of those breakouts will lead to reversals. And a reversal is simply a trend bar in the opposite direction, which is a breakout. I said bears will sell strong bull closes near the top. They'll also sell reversals down, which is slightly higher probability than selling the bull closes. A pair of very strong bear bars at the bottom, terrible follow through. Another bear breakout attempt, another one, and they're all failing. Very strong bear bar closing far below the low of this bar, but still within the trading range. Bars like that trap traders into selling low. Traders are naturally hopeful, and then thinking, wow, that's so strong. This has got to be the start of a bear trend. And look at this. We had an extremely strong bull bar, and now we're breaking below the low of that bar. So certainly this will end up as a measuring gap and lead to a big move down. Well, it did not break below the low of the trading range, and the next bar has a bull body. Chances are this bear breakout will not get very far. And the bulls know that. So every time they see a big bear bar closing near the bottom, well, they're going to be buying those bear closes, betting that the 80% rule will apply, that bear breakouts will fail. Every big bear bar that looks like a strong breakout and the start of a bear trend, they buy. They bet that 80% of the time those breakouts will fail. Other bulls prefer to buy reversals up, so they'll buy after the breakout reverses up, above bull bars here, 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 and here. I began talking about what exactly I mean by a breakout. I then moved on to my 80% rule, that 80% of breakout attempts will fail. Next, I made a point that every reversal is a breakout in the opposite direction. I may not call it a reversal, and I may not call it an opposite breakout. I typically call it a reversal, but it is a breakout, even though it may not be obvious on the time frame in front of you. And finally, because of the 80% rule, if the market's in a trading range, it does not matter how strong the bull bars are at the top or how strong the bear bars are at the bottom. The breakouts are probably going to fail, so traders buy low, they sell high, and since they expect the trading range to continue, they scalp, they take quick profits. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on breakouts.